Hello everyone, welcome back to the channel, and today we'll try to understand and try to master the physics of the market movement, the market structure, and all of these things are essential if you want to be able to read the markets, to read the price like a trading professional. So really important to understand the fundamental basics of how the market moves, what is an impulse, what is an retracement, or how to draw a trend line properly, how to use it, how to understand where do you need to open buy positions, where do you need to open sell positions. So this is crucially important if you want to become a better trader. You need to understand the physics of the market, how the price moves, and in this case, when you will understand it, then you will be able to make more money. You'll become a better day trader. First of all, let's understand the theory and what you need to understand about the basics of the market. So the first thing that you need to understand is how can the market move and the three different ways the market moves. So the first way is a bearish trend, and you probably think this is pretty simple, I already know this. The second way is a bullish trend, and when the market is moving upwards. And the third way is a side moving market. So this is really important to differentiate, because some people doesn't really understand that there is a thing called side moving market. But side moving markets or consolidations are essential. It provides us with great information about the trend, about the market structure, about the whole market, what the market is doing. Maybe it is resting, maybe it is accumulating, and so on, depending on the market. So first of all, if you want to understand, you need to differentiate these three things. When you open a chart, you need to understand whether the market is going downwards, whether it is going upwards, or whether it is going sideways. And it's not really that simple, because if you look at the real market conditions, for example, over here, if I would ask you, for example, whether this market is moving upwards or downwards or sideways, or where this market moves. So if we look over here, if we want to identify whether this market is in a side moving market or in a bullish trend or in a bearish trend, we need to look at the highs and the lows. So for example, we can mark these lows right here. So we can see that we have the market low over here. And where are the highs? So for example, now in this screen we can see that the market highs are over here. So we can mark it. So in this case, I'm not marking support or resistance levels, but these can work as a support and resistance levels as well, because these are the highs and the lows of the market, and it is well known that this works as a support and resistance levels. Then we can move further, and then for example over here we can see that the market breaks highs, and that means that we are in a bullish trend. And if the market would have broken these bearish highs, then we would have a bearish trend. So if you want to first of all understand the physics and the movements of the price, you need to understand where the market is moving. If the market would have been resisted from over here and would have continued to this support level, then gone upwards, then downwards, upwards, downwards, basically not breaking these highs and lows of the price, then we would have a range of the price, and basically, in other words, it would be a consolidation or side moving market, because the market is moving up and down, and not making, the most important part here is not making any higher highs or higher lows. So when you identify this, the most important thing to understand here is when you identify, for example, a bullish trend, avoid opening sell positions, because it is really risky. If the market is going downwards, you have a very limited amount of price for you to go short. So if the price is moving upwards and you open a short position, most likely the price will not be able to reach your take profit, but will be able to reach your stop loss. And same happens in a bearish trend. If the trend is bearish, you need to open sell positions and not buy positions, because if you open a buy position, most likely the price may go a little bit in your profit if you were lucky, but then eventually the price will still continue its bearish trend, and if you have bought, you will be losing. So it is really important to understand before anything where the market is moving and the market trend. And again, if the market is consolidating, only consider opening short or long positions at these reversal points right here, which may be a little bit hard to identify. So when you identify this, you need to look at market structure. Another way to identify the short-term market structure is to look at the short-term lows and highs of the price. So for example, if we look over here, we have this impulse right here and we have the high of an impulse. So we can mark this high and this is swing high, and then there we have a swing low, because if we take this particular move upwards, we can see that this is the low of the move and this is the high of the move. Then we have an impulse. So we'll talk about impulses and retracements later, but then now we have or in this case, I think this is a retracement rather, and for example, I can mark another low, and then I can mark another high and another low, which is right over here. And now it is pretty obvious where the market is going, because if we have a higher lows and higher highs, then we have an upwards moving market. Imagine you are in, for example, in this situation over here, you are not sure what to do, what the hell the market is doing. Anyway, then you can look at these highs and lows, and then you can understand that the market is moving upwards. And if the market is moving upwards, you can anticipate that this low will be higher than this low. We can even rewind the price a little bit to better visualize this. So imagine we're in this situation. So in this case, maybe you're wondering, maybe you think that opening a short position would be a good idea. But if you leave the price like this, for example, imagine over here, you're thinking now the price is definitely moving downwards, I will open a short position, and you open this short position, your take profit is at least somewhere over here, and then look what happens. You can play the price and you are happy, you are in profit, everything is going great. You do not want to close this position early because your take profit's over here, and if I leave the price going, you can see now the price starting to reverse a little bit. At this point, you will definitely would be not sure what to do, whether this is a healthy retracement and the market will go into your take profit, or the market will retrace and you are afraid but you are still holding your position, and then boom, the inevitable happens and you are getting stopped out. And this is really a mistake by majority of beginners or even intermediate traders. They're not really identifying properly the trend of the market, and they're opening some random positions, which usually leads to losses. So this is how it happens. But when you identify this correctly, again, we can, for example, come back to this place over here. So in this case, we are not doing anything because we already established that the market is going upwards. We can even mark some sort of a trend line. The trend line will, in this case, probably will not be able to tell us exactly where the price will go, but it gives us an idea of where the retracement will happen. In this case, it is happening over here. So then what we need to do is scale down to lower time frames, and again, so if we scale down to lower time frames, we still need to understand these highs and lows of the price. So for example, over here, we can mark this low right here, and remember, if the market breaks the low, that means that we are now starting to move upwards. But in this case, so let's play the price and see what is happening over here. So now we can see that the market is consolidating, and in this case we are definitely not opening short positions because the market is not moving downwards, and we are not opening buy positions. So we are safe right here and we are waiting to see what the market will do, and then boom, eventually we can see that the market is starting to move upwards, and we're still not doing anything, still waiting patiently when the price will break this level. So again, let's play the price and see what will happen. And the price is now starting to break this level. And what does it mean? It means, first of all, if we look at a longer length market structure, we can see that here we have an end of retracement. So this is really important information. Now we are on a verge of reversal, and if we look over here at the short-term highs and lows, we can see that the price is now shifting to the upwards. We also have a ascending triangle right here, but this video is not about ascending triangles, so we can open a buy position right here because we know that the market will continue moving upwards, and it doesn't really matter. It really depends on your risk management. This is probably too wide stop loss. I would leave stop loss to this previous low or this previous low, and then we have a pretty huge position. So let's play the price and see what happens. and the price will eventually move upwards. And this is how you identify the market movements. You need to understand these highs and lows. You need to understand the longer length highs and lows. So you need to understand whether the market is moving upwards, moving downwards, or moving sideways. If it is moving sideways, don't use this strategy because it will probably not be great. But if the market is, for example, bullish, you need to identify the reversal properly and then trade the reversal. Or you can also trade the continuation. In this case, imagine, for example, that the market would actually break to the downwards. Then it would be a great idea to open a short position, because then the market broke this previous low, and that means the market is going actually lower, and then you could potentially open a short position and make money. So this is crucially important to understand. If you understand this, you will be more profitable and you will avoid a lot of potential losses. So hopefully you guys enjoyed this episode. Leave that like button, subscribe, and see you in other videos.